Hey, everybody. Welcome to another Monthly Market Matters. This is a recap of the month of July. I'm Jason Rankin.
I'm
And
Kyle Triple.
Go for it, Kyle. How did we finish up?
Well, it's been a good year so far, and July continued to be a good year. So it's one of those. It's completely different than what we experienced in 2022 or last year. So we've had the markets up pretty good this year across the board. Most indexes are up anywhere from 8, NASDAQ's all the way up to 20, over 20% this year. So actually 35 as of the end of the month here. So one of the things we've been talking about is the difference between last year and this year. But it's not just a market that's up overall. It's really been a key area of the economy, the tech, the NASDAQ, and namely 7 stocks that have really been driving this entire market. I know that we've been talking about it and clients have been asking about it. You turn on the TV, you see the NASDAQ's up, or you see the Dow's up, or you see the S&P's up. And well, not all things are created equal. And so one of the things we've talked about a lot lately and in client meetings and in the office is really the S&P 500 is 500 of the largest companies or stocks out there. And, 70%, as you'll see on the slide, of the entire returns of the index come from 7 stocks. And all those stocks have been around the technology area. You look at them right here on the screen with NVIDIA, Meta or Facebook, Tesla, Amazon, Apple, Microsoft, and Alphabet or Google. So, I mean, really, those 7 stocks are accounting for over 70% of the returns. And you can see on the slide here how much those individual stocks are actually up this year. And
I was going to say real quick, I think it's very relevant to our demographic, and we do work with some younger people, but I would say the lion's share of the folks that we work with are probably 5 to 10 years away from retirement or are already retired. And the average retiree's portfolio that we work with, you're not going to see giant positions in Facebook, NVIDIA, Tesla, Google, etc. So that's where I'd like to take the time and really explain what's going on behind the scenes. Because if all you do is just look at your phone or look at the news, oh, the market's up X, the market's up this, as you were carrying on with that last slide, when you back out the math, what that basically works out to, you pull these 7 stocks out of the S&P 500. So now that you have the S&P 493, the market's really only up about 4 or 5%. And that, for many folks who just have bonds, treasuries, maybe some cash or CDs, blue chip stocks or blue chip index funds, things like that, that's a little bit stronger representation of what most folks are seeing. Not many people out there, including some of the smartest hedge funds, had money concentrated in tech stocks just because of how bad they were last year.
Yeah. And we said, too, these 7 stocks are making up over 22% of the S&P 500. 500
as far as the weighting.
The weightings. Yeah. So not just the returns, the actual position, the weighting in the index. So you have 7 stocks accounting out of 500, accounting for over 23% of the entire index of the 500 stocks. So it's definitely been skewed there, but it's also along the lines of what you said, is that most of our clients out there aren't overly concentrated, overly weighted in these 7 stocks. And that's for obvious reasons. I mean, those stocks, if you look at what their numbers were last year, would be a lot different too.
Right. Now a driver of this is most people have kind of heard through either news or media or just kind of through the grapevine of friends talking. A lot of this is AI driven. This started with ChatGPT, 6-8 months ago, and then this fast AI revolution has really driven the price of these stocks. Now the jury's out as far as when this will come to fruition. Usually when we see new technologies, whether it be electric cars or hydrogen power, we were talking about for a while with vehicles, or even way longer with the internet, usually the excitement comes on immediately, stocks drive immediately. But then in the past, what we've seen is these kind of come out of the clouds, and then it takes a little while for the tech to be built back up. I mean, we've been talking about EV cars for a while. So will AI move as quickly? We don't know. Or will it take much longer? We don't know that either. But these tech stocks have really jumped in just a 90-day to a 180-day period of time on that.
Well, I think like all technologies are all new things that come out, and not everybody in the area is going to be a winner, right? So it's a concept of technology and AI, and it seems like it's lifting all boats right now. But at the end of the day, there's going to be stocks like NVIDIA that we're seeing here that have really benefited from that this year, up over 190%. That may be the winners. And so there may be kind of a reshuffling that happens down the road too, as this technology kind of advances and becomes a lot more available.
Agreed. Next 6 months will definitely be interesting.
Yep. Well, we're kind of here towards it. Like I said, this is the end of the month of July, and we just had the recent Fed meeting come out last week here on Wednesday. And they did raise the rates another quarter point. I think that was pretty heavily forecasted and wasn't really any surprise to anybody. But just to bring that perspective, I know we spent a lot of time in previous monthly market matters, as well as a lot of our roundtables over the last year and a half on the Fed, interest rates, inflation, because that was a main impact and a talking point on the markets, especially the bond market and fixed income market last year. So this marks now the 11th time they've raised rates since March of last year, and the 4th time this year. So I know we've hit that a lot, so I don't want to just pound on it over and over every month, but it's up over 5% since the floor there, really. And so that's something that came out this week that they're talking about. And I think that now we're kind of looking at what the expectations are. I know if we go back and look at some of our previous recordings, we were talking about potential pauses in the middle of the summer and maybe even some cuts at the end of the year. And it just hasn't worked out that way. A lot of it because of the data that's been coming out and the strength in the overall the market so far this year, and the labor market too. So
yeah, the can's getting kicked down the road as far as when they're going to stop and when they might even cut. Next slide that I've got here is going to look at the forecasting of rates. And so this is obviously subject to change. This has been wrong in the past, just because, you look at 6 months ago or even 3 months ago, there was not expectation that they were going to raise rates here just this week. And yet they did. But this is the best sentiment right now as far as where things are. The leading economist right now, and as whereas the bond market is forecasting that we can see, is that the Fed is going to stay paused the rest of this year. And so this blue line, for those that are watching can see, this is the forecast of where the government, we believe the government will hold rates. And so stay relatively steady for maybe about almost a year, kind of hovering around the 5% or north, and then may very well start dropping off. Now, what will adjust this line in the future, whether or not rates stay higher for longer or come down faster? My thoughts there is that if this inflation ends up being stickier for any reason, or the economy is not slowing down at all, then Jerome Powell's probably going to keep rates higher for longer. The other side of that would be if the economy slows down faster than they expected, earnings really come down, and if we went into a pretty strong recession, then they'll probably cut sooner. And so that line's subject to change, but I bet it's somewhere in the middle of those.
Yeah, and I think like you said, talking about the projection over the next year or so, but as far as the next meeting coming up here in September, I think most of the futures markets are predicting about an 80% chance, give or take, that they hold rates there. So right. Obviously it's data driven, as we've talked about, and a lot can come out between now and then and can influence or impact that decision. But that's kind of where things are at right now. We've talked about the impact of inflation in the bond market and on the overall economy and people's spending and just the cost of goods, if you will, and then what the raising of these rates has had the impact. But we've also highlighted the benefits of it too. There is some silver lining on that. The negative or the downside is if you're in the market for loans or taking out a loan, whether it be an auto loan or a business loan or a mortgage. Rates have gone up quite a bit in the last year and a half, and that's not a benefit to you in that process. But for clients that are out there looking for options for money that is on the sidelines or safe for rainy day money or our cash, we've hinted at before, it makes sense to shop that cash now, and we've been benefiting from those higher rates with our safe investments on the money market rates, the treasury rates, and our CD rates. So I think most of those right now that we're able to buy in the last few weeks or months have been north of 5% across the board on those. So
I think it makes sense, Kyle. Like I've, we've all, as I kind of talk to folks, for the last 15 years, it hasn't mattered where people kept their cash because everyone paid zero. Yeah. The government lowered interest rates down to essentially zero right after the great financial crisis back in 2008. Right. And they just hovered there for better part of 15 years. And so it didn't matter if your cash was at Bank of America, a credit union, Wells Fargo, Vanguard, Fidelity, Schwab. It didn't matter because everyone paid zero. So you didn't need to shop it. But you would shop your mortgage. Okay, because you can borrow rates at different prices. So it made sense to shop when you're borrowing money, but it didn't really make sense when you're investing money because everyone paid zero. Now we're kind of seeing the other side of it. So this is the first time rates have gone up. We've seen these levels in 15 years. And so now it actually makes sense to shop. I made a joke with one client. I said, if you're keeping your cash, I said, if your bank has a building, you're not getting the best rate. If it's a brick and mortar, usually you're not getting the best rate because they've got stronger overhead. And so whether you hoard cash at Schwab or Vanguard, Fidelity, or Capital One or things like that, we're starting to see rates dramatically north of zero. And so that's kind of the message here to the clients is just do your homework, talk to us, and look around. But if you're getting 0% on your cash, there's probably a better alternative.
Yep.
Okay, moving on. What else we got going on?
Well, I think part of that, along with the lines of inflation, we have led to the talks we've had for recession. If when I know we've projected or predicted it's been the longest forecasted recession the last year and a half. They've been talking about it nonstop. But one of those factors and driving points is the measure of GDP, right? So I think you had something you wanted to talk about on GDP and where those numbers are at, and kind of what that looks like and how that affects the potential recession.
Well, we're going to get in here. Besides GDP, we're going to talk about housing a little bit too. So there's been a number of surprises this year. If you got all the leading smartest economists in the room, in December of last year, I don't think any of them would have got this right. First one being GDP. So we have not gone into a recession yet here in 2023. Most leading economists last year thought it would have already come, first quarter, and we're still at a 2.6% growth. I think that these, leading economists and all the news that I read are still expecting this to continue to slow down because having high interest rates is inevitably going to slow the economy down. It's just a matter of when, and that's where the jury's out on this. But that's where our are right now, 2.6. I was going to segue quickly to another thing that's a surprise is going to be the housing. And so if you look, I've got a chart here. Let's touch on this really quick too. This is a driver too of what's happening with the economy, what's happening with interest rates. This is just a quick blurb on what's happening with inflation. It continues to come down. But a driver of that too is going to be home prices. And so what a surprise and mystery here has been around home prices. Most people thought that with mortgages around 7%, that it would have crashed real estate. I talked to a lot of people last year that hadn't got their first home yet. And they said, well, I'm going to wait till next year because I know prices will be down 20, 30%.
Right.
So I've got a chart here of housing prices. And I think we're only down, let me flip to another slide. We're only down about 1% on the home price index from where we were last year at its high. So real estate has really not gone down much at all. And when you think about this from the outside, what makes sense with this is going to be the supply. So when you have mortgages at 7%, housing supply is at record lows. And the main reason there, if you think about it, for any of you that have a 3% mortgage, I don't care how much you want to move, you're really going to have to weigh that decision. Right. If you've got a 3% mortgage and for you to move, it's going to take you north of 7. So we're seeing the inventory in the existing homes dry up completely, and that's keeping prices high. Pretty weird.
Well, in housing market is a major driver and impact inflation. That's kind of how that all ties back in, right? So we're looking at inflation coming down. We expected, the impact there from whether it be gas prices or goods as far as your groceries and things too, and then home prices. So those are all things that have a big impact on inflation. And I think a lot of people were expecting those high prices to come down a lot faster, but it's a lot of the other goods in the areas like the gas and the commodities there that have come down significantly, have impacted the inflation number more so than the housing market right now.
There you have it. Quick and dirty for you guys. What do we got coming up next, Kyle? We got our round.
We have our mid-quarter roundtable coming up in August. Yep. So that'll be our next piece that comes out here. That'll be our longer, 45 minutes or so to an hour that you'll have all four of us on and just going about what's happening this year, what we're talking about with clients, what clients are coming in with questions. And that's something we encourage you guys to do. You can reach out to us and submit any sort of questions that have come up or things that are on your mind, things that your friends are saying and things that are on your mind that you're thinking, and happy to try to address some of those. And obviously the ones that we get the most interest in are the ones that drive a lot of the conversation on those mid-quarter roundtables.
There you go. All right, buddy. Thank you. Thank you, everyone.
Thank you all for tuning in.
See you next time.
Bye.